Welcome, future CPAs. If you're a BS accountancy student getting ready for the LECPA, you are exactly where you need to be. Today, we're going through a specialized explainer on Section 34 of the NIRC. That's Ordinary Allowable Itemized Deductions. Now, to make this actually stick in your brain for the next 2 or 3 years, I want you to visualize gross income as this super exclusive VIP club, right? Not just any random expense can stroll through those doors. The BIR has set up some absolutely massive bouncers to keep the riffraff out. So let's dive right in and figure out exactly how to get your deductions on that guest list. Okay, here's our rapid-fire roadmap. We've got 1, the deduction VIP test, 2, business expense rules, 3, deductible versus non-deductible taxes, 4, interest and the arbitrage limit, 5, the bad debt tax benefit, and finally, 6, depreciation ceilings. Let's do this. Section 1, the deduction VIP test, getting past the BIR bouncers. So before an expense can even dream of reducing your taxable income, it has to face these strict bouncers standing outside the club. And the strictness here is absolutely crucial. Every single expense must pass these 6 golden tests. It's got to be ordinary and necessary, paid or incurred within the taxable year, connected to the trade, business, or profession, reasonable in amount, and of course, fully substantiated by official receipts. Miss even one of these, and boom, you're bounced. Oh, and a huge update for your board prep. Under the new Ease of Paying Taxes Act, that old rule where you had to prove you withheld taxes just to claim the deduction, completely repealed. Gone. Let's pause for a quick active recall here, because LEPA examiners love testing these boundaries. What about bribes, kickbacks to government officials, or just your own personal living expenses? Are they getting in? Yeah? No way. That's a hard no. They are automatically bounced at the door. Only legitimate, perfectly documented business expenses get past that velvet rope. Section 2, business expenses, the VIP regulars. When we look at VIP regulars like salaries, travel, and repairs, examiners love to test your classification skills. A classic exam trap is repairs. You just need to ask yourself, what is this repair actually doing? If it's an ordinary repair, it just keeps the asset running in its normal operating condition, you expense it immediately. Totally deductible. But if it's an extraordinary repair that actually prolongs the asset's life or levels up its value, you can't deduct that outright. You got to capitalize it and recover the cost slowly through depreciation. All right, next up is entertainment, amusement, and recreation, or EAR. Look, the BIMS knows businesses love to wine and dine their clients, but they definitely cap the party. You have got to memorize these exact limits. If a taxpayer is selling goods, the maximum deduction is just 0.5%, 0.5% of net sales. But if they're selling services or leasing properties, it's 1% of net revenue. Literally, write that down right now. It is heavily tested. Section 3, deductible versus non-deductible taxes. Now, warning, this next part is a classic multiple-choice minefield. The general rule is that taxes are deductible if they're connected to your business, but the trick is knowing exactly which list a specific tax falls into. Deductible taxes include things like import duties, local business taxes, fringe benefit tax, and documentary stamp tax. But on the flip side, you can literally never deduct Philippine income tax. I mean, think about it logically. You can't deduct your income tax to compute your income tax. Make sense? Likewise, estate tax, donor's tax, and VAT are strictly non-deductible. Time for another trap. What about late payment surcharges and penalties? Are those deductible as taxes? Absolutely not. The BIR is not going to subsidize your bad behavior. But here is a secret study hack. While the penalties themselves are non-deductible, the interest on those delinquent business taxes actually is deductible. You just classify it as an interest expense, not a tax expense. Section 4, interest expense and the arbitrage limit. The BIR wrote the rules for interest for one very specific reason. They do not want taxpayers double dipping on tax benefits. So to claim interest, it has to be stipulated in writing, legally due, and strictly the taxpayer's obligation. Also, interest for petroleum operations, not deductible. But the massive red flag you really need to watch out for is related party transactions. Interest paid between related parties is just never deductible, period. The magic number for interest is 20%. This is the arbitrage limit. See, the government taxes your passive interest income at a final tax rate of 20%. To stop you from just borrowing money to earn that interest and claiming a huge deduction on the higher regular corporate tax rate, the law steps in. It requires you to reduce your allowable interest expense by 20% of your interest income that was subjected to final tax. So, how do we hack this for the exam? Well, you need to know exactly when that arbitrage limit drops to 0%, which means your interest expense is fully deductible, no reduction needed. This happens in two scenarios. First, if you just don't have any interest income subject to final tax. Makes sense, right? Second, if the corporation is already subject to the lower 20% regular corporate income tax rate. If you spot a 20% RCIT corporation on the exam, skip the arbitrage math entirely. Section 5, the bad debt tax benefit. I always like to reframe this one as the ultimate comeback story for a business loss. If a client owes you money and they just completely ghost you, the BIR might let you deduct that loss if you follow the steps perfectly. So chunk this into a 4-step sequence in your head. 1, it's got to be a valid debt. 2, connected to your business. 3, you must have diligently tried to collect it and ascertained it is absolutely worthless. And 4, it has to be physically charged off your accounting books within that exact taxable year. Oh, and remember that related party rule? Yeah, it applies here too. Bad debts between related parties are never getting into the VIP club. But wait, what if a miracle happens and the debtor actually pays you back a year later? That brings us to the tax benefit rule. Basically, you only declare that recovery as taxable income if the original bad debt deduction actually saved you money on your taxes in the previous year. If your business was already operating at a massive net loss and that deduction didn't reduce your tax bill at all, then recovering the money is completely non-taxable. It's just a return of capital. Section 6, depreciation rules and ceilings. So you probably know the basics of depreciation from financial accounting, but taxation has some very specialized rules examiners love to pull out. The BIR accepts your standard straight line, declining balance, and sum of the year's digits methods. But here's the specific study hack you need for petroleum operations. Their properties are depreciated over 10 years if the asset is actively used in operations. If it's not used, it's depreciated over 5 years using the straight line method. And when it comes to luxury, the BIR takes some very strict stance. 2.4 million pesos. That is the hard value ceiling for a non-transportation land vehicle. If a company buys a flashy luxury car for its CEO that costs more than 2.4 million, 0 depreciation is allowed. None. The same goes for yachts, helicopters, airplanes, unless, of course, the taxpayer's main actual business is transporting or leasing those specific vehicles. Rapid-fire LCPA cheat sheet. Okay, we've covered a massive amount of ground today. Let's synthesize this into a mental screenshot you can just pull up on exam day. The absolute key here is understanding why these rules exist. The BIR blocks related party transactions to prevent fake manufactured expenses. They enforce the 20% arbitrage limit so you don't double dip on tax rates. They use the tax benefit rule so they only tax a recovery if they actually gave you a break earlier. And they cap vehicle depreciation at 2.4 million to stop companies from buying luxury toys tax-free. When you grasp that underlying logic, you don't have to rigidly memorize, you just know the answer. I'll leave you with this thought as you keep prepping for the board. To master Section 34, don't just memorize the list. Understand the logic of the bouncer at the door. If you can explain to yourself why an expense should or shouldn't reduce taxable income, you will absolutely conquer this section. Let's wrap up with one final, provocative, active recall question, just to lock all this in. Ready? If a related party debt goes bad, and you follow every single step perfectly, you ascertain it's worthless, you actually charge it off your books this year, can you deduct it? No way. Absolutely not. Related party debts are never deductible, no matter how perfectly you jump through the other hoops. So, keep testing yourselves, keep visualizing that VIP bouncer, and you're absolutely going to crush this exam.